Many people ask me, how can I increase my borrowing power? Since lenders have become less lenient of recent, increasing your borrowing power using these simple techniques could mean the difference between buying that property you dreamed of or missing out on it due to insufficient funds. Hi, I'm Ryan McLean and I'm from cashflowinvestor.com.au, and I want to share with you 12 techniques to quickly and easily increase your borrowing power. I'm not going to waste any time, I'm going to get straight into it. Tip number 1. Minimize your available credit. If you have credit cards, 3 credit cards, they all have $10,000 limits on it, you're not actually using it, you've just got these limits saved up for a rainy day, that can actually hurt your borrowing power with the banks. The reason for that is the banks look at that as debt. Remember, even if you have $0 on your credit card, the banks are signing you up for maybe 25, maybe 30 years. They're looking at that credit card and saying, in 1 year, in 5 years, in 20 years' time, this person could effectively have a $10,000 credit card debt. Looking at minimum repayments on credit cards of maybe 3%, they might say, this person is going to have to pay $300 per month to the credit card company for every $10,000 limit they have on their credit card. So me as a bank, I'm going to protect myself and I'm going to take away $300 per month from their serviceability and give them a smaller loan. So if you have excess credit cards that you don't need, lower the amounts on them or get rid of them altogether. Tip number 2, claim all your income throughout the year, even cash payments. Now there are obvious benefits and obviously not legal benefits to not claiming your income. And some people do this. I'm not endorsing this at all, but some people don't claim all of their income because you don't have to pay tax on income that you don't claim. However, this can severely hurt you when it comes time to borrow from the bank and will limit your borrowing power. By claiming all of your income, you're showing the banks everything you earned for that year. Banks won't just look at your last 2 income reports or your last 2 pay slips. They will look at your last 2, they will look at your last 2 tax returns. So they will look at the last 2 years and how much you made. So the more money you claim, yes, you have to pay tax on it, but the banks will actually look at that and see that as a more stable income and then increase your borrowing power for you. Tip number 3, have your tax returns up to date. By having your tax returns up to date, you allow the banks to look in your past records and see your income, see your stable, see your steady income, and this can help to increase your borrowing power. Tip number 4 is to split liabilities and debts with your partner. So if you're just going for the loan yourself and your spouse isn't going to be on the mortgage, then it can actually work in your favor to split your liabilities with them. So instead of you assuming, all of the rent, you assuming all of the cost of living, if you split them up, then the banks are going to see that you are able to service the loan a lot higher than if you had to pay for all of those expenses yourself. Now, there's certain rules around this, so always speak to a taxation accountant before you make any claims or anything like that. Tip number 5, choose a lender that will count your rental income. Now, not all lenders or banks will count the rental income of an investment property. Some banks don't count any of it. Some banks might take maybe a 3 to 4% of the purchase price per year as rental income. And then some lenders will take 80% of the annual rental income that you're expecting to receive. Now, obviously, the more rental income they take into account as income you can use to pay off your loan, the higher your borrowing power is going to be because your serviceability is so much higher. So shop around and choose a lender that will count the rental income for your property. Tip number 6, choose a lender who favors your type of income. There are lots of different types of income. You might earn income from a 9-to-5 job, you might be a contractor, you might be a consultant, you might be a sole trader or a small business, you might have a company. Choose a lender who favors your type of income, because if you choose a lender that favors a different type of income, then they're not going to give you as much borrowing power. Tip number 7, shop around to minimize your interest rate. Different lenders offer different interest rates. So talk to your mortgage broker, shop around for a cheaper interest rate. If you can save 1% on your annual interest rate, you can free up a lot of money that can be used to pay for that loan. If you have a $100,000 mortgage, a 1% saving is $1,000 a year. If you have a $300,000 mortgage, that's $3,000 a year. That's $3,000 a year that you don't have to pay that can be added to your serviceability. So shopping around to get a good interest rate can help you out. Tip number 8, choose the right loan product. You wouldn't think it, but different products within a bank or within a lender can actually have different borrowing powers for you. There are different types of loan products. There's ones with honeymoon periods with a lower interest rate for the first year. There's loans where you get an offset account. There's all different types of home loans, and each different type of home loan will assess you differently. So choose the loan that will give you the highest borrowing power, and the best way to find this out is to ask your lender about your borrowing power for the different loans or to speak to your mortgage broker. Tip number 9, move all your debts into your mortgage. The reason this works is if you have a credit card debt, maybe $10,000, and you're paying 20% interest on that, and you roll that into a mortgage that's 5% interest, well, you're saving 15% interest per year. Your outgoing payments comes down, and therefore your serviceability goes up, and the potential for a higher borrowing power goes up also. Tip number 10, use your other properties as collateral. So if you have other properties, then use them as collateral for the new investment property. And banks love this because it means if you go belly up on your investment property, they can effectively use your house or your other investments as security to make sure they get their money back. By doing this, sometimes you can help to increase your borrowing power, but just be careful because if the market turns, I have heard of people where they have cross-collateralized all their properties, have been stung by this and have to pay back the bank money that they could have used to reinvest. Tip number 11, look at interest-only or longer-term loans. The reason this works is, again, improving your serviceability. Because interest only, all the banks need to look at is whether you can pay the interest on a monthly basis rather than the principal and the interest. The costs of that loan to you are going to be lower, so your borrowing power could be higher. Again, if you extend the loan from 20 years to 30 years, you'll be paying less principal off the loan, and therefore your monthly repayments will be lower. Tip number 12, which is not a quick tip, it's save a larger deposit. Now I know this isn't quick, but it can be very helpful. If you only have a 5% deposit, you're going to have to pay lender's mortgage insurance, and your borrowing power may be limited because of that small deposit and the risk the banks are taking. If you have a 20% deposit, that puts you in a really good position. Most banks and lenders won't charge you lender's mortgage insurance if you have a 20% deposit. If you go even further and have a 30 or a 40 or a 50% deposit, then you can even go as far as get low doc loans with the bank and all sorts of things. So saving a larger deposit can help you. So, they're the 12 techniques to quickly and easily increase your borrowing power. In today's market, I think they're extremely important tips, and I hope that these have helped you.